At the heart of the Great Depression were multiple stock market crashes that occurred in 1929. These crashes marked the beginning of one of the most serious economic downturns in U.S. history. The Wall Street crash of 1929 unfolded over a series of disastrous trading days. It began with Black Thursday on October 24, 1929, when the stock market lost 11% of its value at the opening bell. Panic quickly spread. A few days later, on October 28, the crisis escalated with what would be referred as Black Monday. On this day, the market plunged another 13%. The following day, October 29th, became infamous as Black Tuesday. The market tumbled an additional 12%. The stock market continued its downward spiral after the 1929 crash. By 1932, the stock market had lost a staggering 90% of its value, estimated to be around $50 billion, equivalent to hundreds of billions in today's dollars. What caused this catastrophic crash? There were four main factors. A speculation boom. During the 1920s, the stock market experienced rapid growth, with the Dow Jones Industrial Average quadrupling in value from 1921 to 1929. Speculators bought stocks on margin, meaning they borrowed money to buy stocks. This led many stock traders to become over-leveraged. Hence, when stock prices fell, they faced margin calls which they couldn't meet, and led to the forced sell of stocks, driving the market down further. Because many banks and financial institutions extended loans for these speculative purposes, they also became vulnerable to stock market declines and lost large amounts of money. Extreme market overvaluation. Before the crash, stock prices far exceeded the actual value of the companies. Federal Reserve tightening. In 1928, the Federal Reserve raised interest rates to curb speculation. Higher interest rates made it more expensive for investors to borrow money to buy stocks. Panic selling. Panic selling during the Great Depression created a vicious cycle fueled by emotions and fear. When stock prices started to fall, investors feared losing all their money. Each wave of selling caused prices to drop more, and created more fear and more selling. The ripple effects through the economy. The stock market crash didn't just devastate investors. It sent shockwaves through the entire economy, triggering a vicious economic downward spiral. The initial crash shattered public trust and confidence in financial markets. People became fearful to invest, afraid they could lose everything. As banks and businesses failed, factories shut down, people lost jobs, leading to a decrease in consumer spending. This created a self-perpetuating downward cycle of the economy. Out of this crisis would come some important changes to the financial system. The government introduced new regulations to assist with stabilizing the system, such as the Glass-Steagall Act of 1933. This separated commercial and investment banking to reduce risk. The Securities and Exchange Commission. This agency was created to oversee and regulate the stock market. This stock market crash underscores the dangers of unchecked speculation, overvalued markets, and insufficient financial regulation. It also serves as a powerful reminder of how a single economic crisis can spiral out of control, triggering a total financial collapse